3.44 on a 10-year. Dollar showing a touch of strength against the euro, a little weaker. A break of 110 to the downside, 109.86. We're negative there by 0.2%. And crude back through 70, up to 3.7% higher right now, to $71 and about 10 cents. 20 seconds into the session, we look a little something like this. We are positive 0.9% on the S&P, on the Nasdaq up by 0.9% also. One stock supporting the price action, Apple, snapping a 4-day losing streak after reporting better than expected revenue on robust iPhone sales. Ed Ludlow covering the story on the West Coast for us. Morning, Ed.
Yeah, good morning, Jonathan. Up 3%. So services actually missed expectations, but it was one of just two categories that actually grew year on year. About a 5.5% gain relative to the same period a year ago. The other outperformer that beat expectations was iPhone sales. Just 1.5% sales growth year on year, but it shows that Apple's weathering the kind of tough environment for smartphone demand globally. Real strength in emerging markets. Tim Cook talked a lot about India and emerging markets broadly. In terms of the limited guidance that we got, it's really interesting to note the impact of FX here as a headwind, about 500 basis points in the quarter gone, but note the forward-looking statement that going into the current period, while there will be an FX headwind to the top line, we actually expect FX to be flat as an impact to the bottom line, and that's the first time for Apple that's happened in a lot of quarters. They're really talking about India. They see a growing middle class, and Tim Cook's hope is that more of that growing middle class in India will buy iPhones. That's literally how he put it. A lot of emphasis on the financial services side of the business being a driver of performance as well. And then the buzzword AI. He was asked about AI by one of the analysts. It was much more muted than we saw from his mega cap tech peers like Meta or Microsoft or Alphabet. But he did say that AI is huge in Apple's eyes. They will be thoughtful about how they integrate it more deeply alongside machine learning into the product base. And again, it was a record quarter for a number of categories, but the important bit is that another record quarter globally for the installed base of products across the entire lineup. So it seems like this was robust print, John.
Looks like it. Looking at the stock move. Ed, thanks for that. Great coverage yesterday evening as well. Apple up by 3.4%. Dan Ives of Wedbush coming up in about 6 minutes' time. Looking forward to that conversation. More from the south side. Jefferies resuming their buy rating on Apple after earnings. They said this: few things in the market are as certain as Apple's cash-generating abilities, product resilience, and remarkably high consumer sentiment. The March quarter had all three on display. That stock 171 in early trading. Let's get to the banks, the regionals, from big tech to some struggling names. PacWest rebounding after plunging almost 70% this week. Its peers following suit heading into the weekend. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, in some ways, the move that we're seeing this morning defies fundamentals. The exact catalyst here may be unclear, but we did get some good news out of some of these names. PacWest in particular, while it did confirm that it's in talks with several investors, it also said this week that deposits have actually risen since March. And Western Alliance, too, said that it hasn't seen any unusual deposit flows since, of course, First Republic collapse, which, granted, was just a couple of days ago. And Bloomberg News also reporting this week that the FDIC will exempt some of these smaller banks from having to kick in extra money to that deposit insurance fund. So some relief there, John. But the reasons for today's rally could be as simple as this sell-off had gotten really dramatic. Even with today's rally, let's focus on PacWest. It's down more than 50% this week alone, so we could be watching some knife catching going.
It was a double-digit stock to start the week. Brutal stuff over the last couple of days. Katie, wonderful, thank you. Let's turn back to the earnings. Two names, Lyft, Carvana. Lyft plunging after delivering a disappointing sales forecast. Carvana, on the other hand, expected to turn a profit following a strong Q1. Abby has more. Hey, Abby.
Hey, John. Yeah, truly a tale of two different car stocks here and stories, fundamentals happening here. Now, starting off with the shares of Lyft, they are plunging, the worst day since February. And as you said, the quarter that was, not so bad, but the quarter that is, the profit, they took the sales guide below what it was expected to be. Carvana, on the other hand, the used car sales company that has had some going concern risks in recent months, well, it's soaring on the company, saying that it will return to a profit in this current quarter. Now, if we return to Lyft, what's going on here, it seems that the demand for ride sharing is pretty strong, but the per rider economics diminishing. So their second quarter revenue range slightly light, the EBITDA range a little bit light there. They're basically sacrificing sacrificing the near term to gain share from Uber in the longer term. Relative to Carvana, the used cars market is stabilizing. The first quarter was strong. So they do see this profit coming this quarter. They're seeking to cut debt. The amazing thing about this stock, John, over the last 2 years, it has gone from anywhere between a $3.72 stock to a $372 stock. Not surprisingly, there's a massive short interest, a 50% short interest, sending that stock higher today. Let's see where it lands as this year trades on.
Their biggest problem right now for Lyft, they're not Uber. Lyft right now is negative 19%. Abby, thank you. Let's get back to Apple. Analysts across the board highlighting their solid results amid a challenging backdrop. Wedbush's Dan Ives calling them LeBron-like results in a shaky macro. He goes on to write, quote, the iPhone beat was front and center and is clearly an indication that where gains in China are continuing despite a murky macro, Apple remains our top tech pick. Dan Ives joins us right now. Now, Dan, I know you're constructive, so work with me. This is from your own note. Total revenues down year over year. Let's go through piece by piece. iPad revenues down year over year. Mac down year over year. China down year over year. Dan, is this a growth stock anymore?
Yeah, but look, you guys talking about the 500 bip headwind from FX, which is important when you look at what real call constant currency growth is. Look, China increased 500-600 bips sequentially, and I think in the next few quarters you're going to see growth and go into next year double-digit growth. I think it's about that install base. I mean, they're further monetizing it. They're gaining share in China. And ultimately, from a street perspective, it was a Goldilocks quarter.
Let's talk about the buyback plan as well. Another $90 billion, raising their dividend for an 11th year in a row. Can you frame, Dan, how powerful that is? I had one analyst say to me and the team yesterday that if you don't want the stock, Apple's going to buy it anyway. Is that how powerful that buyback plan is?
It is. Look, and I think right now it's a safety blanket stock in what's a shaky macro, and you're seeing that across big tech. And for Apple here, this is just a further flexing of the muscles from the buyback dividend to what's happening in China. And you really start to think about the narrative here with services now starting to show an uptick on the App Store. If you think about the reasons not to own it, I get valuation as some continue to sort of view a glass half empty. Some of the parts, we think this is a stock that goes north of $200.
Services came in a little bit lighter than expected, Dan. The way you painted the picture just then was a constructive way. Why is that?
Yeah, I view it as it's an inline services where the whole focus is can this start to go back toward double-digit growth into the next 2 to 3 quarters. And if you look at the tea leaves with Cook and Cupertino, how they're laying everything out, I think we'll see more at the developer conference in June. I think this will be back to double digits in the next 3 to 4 quarters. And just given the macro, it's sort of a shining light in a dark storm. And that's why I think more and more. And that's just how we're underweight Apple, and they continue to yell fire in a crowd theater. They're just going to have to be forced to owning this because of what's ahead on the product cycle.
Dan, I was speaking to Pierre Farago of New Street Research. He's kind of middle of the road on this name. And there's huge conversations about how to value the stock, what multiple to put on it. Pierre and I had that conversation this morning. Is it a growth name anymore? You suggest it is. Is it a luxury player? LVMH type margins without the price resistance to some of the iPhones. What is it, a staple? Dan, how do you value this company?
Well, first off, in margins, Keane talks about this a lot. If you look now with owning more and more of the chips in the supply chain, I mean, margins are actually increasing, even in a negative growth when you factor currency in. And I think this is all about the install base. 25% of the install base has not upgraded their phone in 4 years. And I think that's ultimately going to lead back to growth, back to double-digit growth. And China, it ultimately is increased not just sequentially, but into next year. So in the macro, it's obviously better than anyone out there. And from a tech perspective, I think it's about what it looks like into the next 4, 6, 7 quarters. Betting against Cupertino, I mean, it's like betting, against Steph Curry, in my opinion.
Well, Steph Curry or LeBron, you've got to pick someone, Dan.
Look, LeBron obviously is the GOAT, but in this series, I think Steph, could be carrying it.
Dan Ives, thank you, buddy. Still constructive on this name. That name is up now by almost 5% in early trading, about 10 minutes into the session. Looking at the broader market, we're up by more than 1 percentage point on the S&P 500. On the Nasdaq, up by a similar amount, and a big bounce back in some of these banking names. Let's get Western Alliance up on the screen. West on my screen has been halted, up by more than 40%. Western Alliance is flying as well. Western Alliance, they're up by 59%. Big moves for some of those names. Big moves. Up 33% on Western Alliance right now. Let's get to iCapital's Anastasia Amoroso. Mike Collins at PGIM joins us now. Anastasia, how hard is it to be constructive on this market, given everything that's been happening over the last couple of weeks?
Well, I think it's gotten a little bit harder, John. And the reason I say that, we had a nice recovery in the second half of April. And at the same time, there's two risks. They're really unresolved right now. And the first one is the banking turmoil. And I appreciate that some of these bank names are up today. But you know what? There's no fundamental reasons for why they're up. And as you talked about earlier in the program, there's no circuit breakers yet in place to end this banking turmoil. So that's one issue that I think markets have to grapple with. And then the other issue, which people are probably not talking enough about, is the debt ceiling. But as you know, the debt ceiling needs to get resolved by sometime in June, and the time to do it is May. So I worry that the policymakers may drag their feet on resolving both of those, mini crises. And for that reason, I'm a little bit less constructive, perhaps near term, as I was coming into April.
That's a change for you, Anastasia. How are you expressing that change over the last month?
Yeah, it is a change. And, coming into April, the view was that it's definitely we're poised for an optimistic shift, and you want to be long stocks. And, I think as stocks have sort of recovered, and maybe some of the tech names have rallied quite a bit, maybe you do pare back some of those gains. Maybe you write some call options on them, especially because volatility has spiked once again. But I do want to make an exception, John, that, I do think the tech resilience may actually continue. And so any sort of weakness that we get in tech in particular, I would be a buyer of. But trimming, whether it's a rebound in financials, or trimming some of the cyclicals, or trimming some of the small caps, to the extent they have any recovery, I would very much focus on getting out of the kind of economically interest rate sensitive names and getting into more defensive tech.
Mike Collins, what do I do with this treasury market? And great to catch up with you, buddy. It always is. Mike, do I buy it because of ultimately lower growth and financial stress? Do I sell it because
Jonathan,
the data looks decent?
I love to come on here and pound the table with a lot of conviction, Jonathan, but with the 2-year bouncing around 4 and the 10-year bouncing around 3.5, it's really hard to pound the table on interest rates. Right now, what's being priced in, if you really step back and look at the big picture, the tail risks, as we talked about, are really fat. There's probably about a third probability of a really strong economy, like GDP growth around 2%. With higher inflation, there's a 1/3 probability that growth just kind of stalls towards zero. And then, of course, there's this big downside, nasty 1/3 probability tail of something much worse, a deeper recession. So if you have the good scenario, rates probably go up 100 basis points. If you have the bad scenario, they probably go down 100 basis points. And here you are kind of stuck in no man's land in the middle. So what we're doing is really looking for backups in yields here to add duration. We are not long at these levels, and I think that's the right thing. With the funds rate at 5.25 and the 10-year at 3.5, that is really inverted, and that 10-year ultimately could get dragged back up if the Fed is able to hold its ground, which is very possible. So you wait for rates to back up a little more, then you add duration, and the same with credit spreads.
Mike, can you think of anything that works in both scenarios?
Yeah, bonds, right? This is actually, if rates back up or stay where they are, Jonathan, you're earning these really big yields in high quality fixed income. It might be a once in a generation type of opportunity. So that's the good news. In the downside scenario, this is a very different world than last year, right? If you have that deep recession, and presumably in that world, inflation does come down, the Fed doesn't cut rates 100 basis points, they cut rates 300 basis points, and bonds kill it, right? So I think it's a carry story, in the upside, and it's a capital gain story in the downside. So this is definitely an opportunity over the long term to have more fixed income in your portfolio.
Mike Collins, Anastasia Amoroso, sticking with us. We'll have a conversation about the latest from the president. He says, my plan to invest in America is working following a robust payrolls report. The US payrolls report coming in hot.
The Fed's not going to quit until the labor market quits. And this is not a quitting labor market in these data.
The reaction from Washington up next.
What they're hoping for is this immaculate disinflation where you just slowly weaken the labor market. Unemployment rate only goes up to about 4.5%. The Fed's not going to quit until the labor market quits. And this is not a quitting labor market in these data.
President Biden likes what he sees. This is what he tweets, quote, "That's 12.7 million jobs since I took office, an unemployment rate that is the lowest since 1969 and the highest share of working-age people in the workforce since 2008. My plan to invest in America is working." AMH joins us now in Washington for more. Morning, Anne-Marie.
Good morning, John. Well, this is an interesting one for the president because, of course, this is the first jobs report we have since he announced he's running for 2024, and he's making his pitch once again for the American people. He's talking about the fact we have this low unemployment rate since May of 1969, and, of course, this massive beat on the payrolls front. Of course, the president's not going to get into the nuance that you and I are going to do, which is, of course, the revisions of 149,000 jobs to the downside, but this is a strong report for them to tout some of these really incredible numbers in the jobs report. Of course, Jonathan, we have to remember 18 months away. That is when we have the next election, and Republicans are going to try to use the economy, most notably inflation, against this president. But expect more from him later today. He's gathering with his cabinet to talk about investing in America, and ahead of those comments about investing in America, what his cabinet and he is doing, he's going to talk about this jobs report.
Lots of nice things to say about the jobs market. I'd like to hear a whole lot more about what's happening with the financial system. Anne-Marie, thank you. Down in Washington, for a final word, Anastasia Amoroso, Mike Collins back with us. Anastasia, is there a good reason right now to buy regional banks?
No, Jonathan, I don't think so. I mean, I think for regional banks, it's a bit of a vicious cycle right now, which is the shares are under pressure and investors and depositors lose confidence, and then deposit outflows can still very much be on the table. And if that's the case, then that potentially can lead to more short interest if that's possible in some of those regional banks. I mean, that's kind of the market cycle vicious scenario. But the other side of it is you've got funding costs that are still rising, have to rise for these regional banks. And at the same time, lending is becoming incredibly constrained, and the demand is falling, the supply of lending is falling. So that's just not a good outcome for net interest margins and for net interest income. So I think it's still a very much challenged area until you either have the Fed that starts to cut rates, or you have the FDIC insurance that actually does cover all the uninsured deposits. Until that, I just don't see a big opportunity in equities and bank equities.
21 minutes into the session, PacWest up by 48%, Western Alliance up by 34%. That's a bounce back, Mike Collins. That's the equity picture. Anastasia went through it there. The profits, they're going to be challenged, Mike. On the debt side, what does the picture look like?
Yeah, it's not a great earnings story, Jonathan. So as a debt holder, you don't really have to worry about earnings growth too much. We are not involved in the regional banks, thankfully. The big money center banks are benefiting, right? They are growing. A lot of people say, why don't the big ones buy the small ones? And obviously you've seen a little bit of that with JP Morgan, but they're already acquiring their business, right? They're acquiring their loan growth, they're acquiring their deposits. The capital ratios of the big banks are awesome. They are really, really good debt investments. We own a lot. We've been adding to them on weakness here. It's a really good opportunity for fixed income investors.
Where are you taking credit risk more broadly at the moment, Mike? Where are you more comfortable doing so?
Yeah, it's really interesting. I mean, you're not getting paid again, not to sound like a broken record for going down in quality here. That 1/3 downside tail I was talking about earlier is not priced into the markets, right? That kind of slow, soft landing is what's priced in here. I mean, credit spreads could be wider, probably will be wider in 6 and 12 months as those tightening lending standards that Anastasia mentioned really come to the forefront. So you stay in the banks, you stay in agency mortgage-backed securities, which have gotten killed. You stay in, AAA asset backs, and you buy all these high-quality bonds. Maybe your, handful of your favorite high-quality, high-yield bonds, which are still attractive given their default fundamentals, and you build a portfolio that's out yielding, treasuries or your benchmark by 200 basis points. I mean, that's what the markets are giving you right now, and it's a really good long-term opportunity.
Just another wild week. I think we're all itching to get to the weekend. I'll let you both go. Anastasia Amoroso, Mike Collins, to the two of you. Thank you very much. About 22 minutes into this session, the broader market, better than okay. It's a bounce back. We're on a 4-day losing streak on the S&P. We snapped that on the S&P 500, up by more than 1%. Let's get you some sector price action. Here's Abby.
And your idea on a wild week is certainly shown here sector-wise, John, because on the day we have most sectors higher. In fact, energy up by 3%. Many of the sectors, most sectors up by more than 1%. But if we take a look at the week that was, not so much. All 11 S&P 500 sectors lower. Big losses. These are the worst. Energy the best today, but worse on the week, down about 6%. Then you have the communication services down. That was some of those mega cap techs. Financials not surprisingly down, and then the materials down too. So much volatility, John.
Abby, thank you. Your trading diary up next. Attempting, trying to take a chunk out of a weekly loss on the S&P 500. About 26 minutes in, we are positive by a little more than 1% on the S&P. On the Nasdaq, up by a similar amount. And those two names, PacWest, Western Alliance, bouncing back as well. Let's see if it stays that way. That's the price action. Here's the trading diary into the weekend and beyond. Fed speak picks back up this afternoon. Bullard and Cook, 1 p.m. Eastern Time. Monday, the highly anticipated Senior Loan Officer Opinion Survey, followed by President Biden's debt limit meeting with congressional leaders on Tuesday. US CPI on Wednesday, PPI and another round of claims on Thursday to get you towards next weekend. Let's get to this weekend. Enjoy your weekend if you can. From New York, this was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into U.S. Trading Day, Friday, May 5th. Here are the top market stories we're following for you at this hour. Fed's move, hike or cut. A blowout jobs number confuses the Fed rate path. We're going to talk to Heather Boucher of the Council of Economic Advisors from the White House. Does the FDIC get a weekend? Regional banks stabilize after a steep rout. We try to dissect the fundamentals from the sentiment and what regulators can do about it. And if you booked your summer vacation, Booking and Expedia reporting strong first quarter bookings. We're going to talk to Glenn Fogel, Booking Holdings CEO, about his summer outlook and profitability. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, that was a surprise for the market, that jobs number.
Absolutely. These are incredibly strong numbers coming out of the U.S. economy right now. Alex, we've seen some repricing around the Fed. You asked the question, are we going to be seeing a hike next in the Fed, or are we going to be seeing a cut? The market has repriced the July cut. That no longer is on the table for the Fed. It's pushed it back, that first cut, to September. But with unemployment at 3.4% and falling, should we be talking about cuts at all?
Well, this is the debate that Guy and I were having after the numbers. I was saying, well, do they have to now think about a hike in June? That's why they kept the options open this week in their press conference, in their statement. And Guy's like, or does that just push out the rate cuts? And I think that that's what we're going to see evolving in the markets.
That's the debate right now, isn't it? The complicating factor is obviously what is happening in the banking sector. That senior loan officers survey Monday, I think, is going to be fascinating. Looks like we've got a bit of a short covering rally into the weekend on some of those regional names. We'll see what the picture looks like on Monday. But let's get back to the jobs report. Here's Rick Reeder from BlackRock earlier after the numbers dropped.
The stories that we're going into recession, deep recession. Well, I'm not sure I buy into that. I mean, think about where consumption is, where income is, where employment is. It's ambiguous to me as to whether, whether we're going to go into recession. But I would say one thing, though. We are slowing. And I think if you actually parse these numbers a bit, and you look at the goods employment, and look at the 3-month moving average, 6-month moving average, 12-month, you're clearly slowing.
Okay, parsing through some of those numbers there. Also, the JOLTS did see some cooling in the job market. Let's go to the White House now with Heather Boushey, a member of the Council of Economic Advisors. She joins us. Heather, it's great to see you. We're going to get through all of this. First off, 500 basis point hikes from the Fed. That's a tightening cycle. Are you surprised at the strength of the labor market?
Well, we have continued to see this strong labor market. We took steps early in the administration to get the economy back on track, recover from this pandemic, and deal with all of the supply chain challenges that the economy was facing. And I think you can see that, the proof is in the pudding. Under the president's watch, we've added 12.7 million jobs now, continuing to add jobs at a healthy clip each month, even as the pace has been slowing. For the past 3 months, we've added jobs at the pace of 222,000 per month, which is less than half of what it was this time last year, but yet that is a strong, stable pace, the kind of pace that is more sustainable than that blockbuster pace we had early on in this recovery, last year and the year before. So, I think what we are seeing now is that as the pace slows down and as we see the recovery in the jobs market widespread, we're seeing that pull people back into the labor force, and this is all good news for the strength of this recovery and for working families all across the country.
Heather, but to pick up on Alex's point, good morning, it's Guy, thank you for your time as well. To pick up on Alex's point, we have had 500 basis points of hikes on the monetary side, and we've still got an unemployment rate of 3.4%, and it's falling. That, as an economist, must surprise you a little bit, and it must make you wonder whether the fiscal side of the equation is therefore still too accommodative. Is there any evidence that, given the rate rises that we've seen, that does imply that fiscal is too loose, too accommodative?
Well, here's the thing. We have seen, those ongoing declines in the inflation rate. It came in last month at 5%, which was, down from where it had been last summer at right over 9%. So that is certainly a sign of slowing on the inflation side, although, of course, prices remain too high. But what we also have wanted to see was continued strength in the job market. We want to see those jobs available for families all across the country. And one of the key pieces in that is seeing people come back into the labor force. We actually saw this month that the share of women in their prime working ages between 25 and 54, the share of them in the labor force hit an all-time series high going back to 1948. So that, I think, is indicative of the strength of this recovery, the fact that if you offer good jobs to people, they'll come back out and get back to work. So it feels like that soft landing that we were looking for, that's where we are right now.
So the president is going to talk about investing in America later on today. The White House is going to be meeting with Senate leaders on Tuesday, or congressional leaders on Tuesday, about the debt ceiling. Do we need more money to invest in America right now? I mean, there seems to be so many options now for jobs, and wages are higher. Do we need that?
Well, here's the thing. Those investments that the president is working with Congress, is delivering to the American people, those are long-term investments. They're, as Secretary Yellen has called, they're investments in the modern supply side of our economy. These are investments that are going to improve productivity over time and lower prices for families over time, and and shore up our nation's infrastructure and help us move to a clean energy economy, among other things. So those aren't the kinds of one-off short-term stimulus that we sometimes have that we during a recession. So I think that it is those investments, though, that are giving investors the signal that, hey, we are investing in moving to build this clean energy economy. We need to make these fundamental changes in how we power our energy grid and how we power our cars and all the like. That's going to require is sustained capital investments, and I think we're seeing signs of that in the data, and that is the purpose of that Invest in America agenda.
Heather, I hear what you're saying about the need to invest, and in theory that should long-term have a massive benefit for the U.S. economy in terms of productivity. But you look at the data right now, you look at this unemployment rate, you look at where inflation is right now, and you have to question whether this is an economy that needs the kind of stimulus that you're talking about.
So I would just stress that that isn't stimulus. And if you look at a figure of when that money goes out the door, it's over the next decade. It is not clumped to this year and next year. It is spread out over time. And in fact, the money hasn't started flowing yet in large part, right? All those tax credits from the Inflation Reduction Act, they are not entering the tax code until next year. So the money is not actually out there in the economy yet, even though money is starting to flow through the bipartisan infrastructure law as infrastructure starts being real built. And that is yet absolutely imperative for economic growth and stability. And, let's not forget that the purpose of all of this is to deliver an economy that works for working people and families all across the country, creating those good jobs that people can rely on and that economic security that they so desperately need.
Heather, it's not positive right now for those people looking for jobs or economic security are banks and regional banks. What are you guys talking about right now on how to stabilize the regional bank sector?
Well, certainly there's been stresses in the banking sector, and through bold and decisive action that the administration has taken and the FDIC, we've been able to see stability come back into that system, and we've seen deposit flows again stabilize. So I think there are indications that we are in a better place, certainly, and we continue to watch the situation as it unfolds.
Heather, the market keeps pushing the banks around, though. Today we got a huge rally. Yesterday we saw a huge sell-off. Today's probably short covering. I wonder whether we're still treating some of these names, these regional banks, on their fundamental benefits, or whether or not this is a sentiment story and other things are coming into play. If this continues, do you think you should be considering options like you did back in 2008? Should we be looking at short selling bans, etc., in order to stabilize the situation? What other levers can you pull to stabilize the regional banks?
Well, so the information that we have at this point is that the situation remains under control. Certainly the FDIC and Treasury are watching these things very closely. You also noted that next week we have congressional leaders coming to Washington, to the White House because of the challenge that we are on the precipice of increasing the debt ceiling. And so, as we're looking out at some of the risks facing the economy, breaching that debt ceiling actually could be quite catastrophic for the economy in the near term. And it's something that we actually are quite also urgently focused on.
Just one more part on the short selling ban. Is anyone talking about a short selling ban that you've heard?
I think at this point, the president is certainly looking at the options on the table, but at this point, they have things under control.
What about a deposit guarantee, Heather? That's also being considered as well. Clearly that would be something that would require you working with Congress, but there may be other options, short-term options, that could give you some wiggle room there to provide the clarity and the certainty that to the American people that their money is safe.
So the president has been clear, through the bold and decisive actions that the administration has already taken. We've been able to secure deposits and make sure that those folks that depend on the safety and security of their banks have been able to be made whole, while also making sure that investors in those banks are the ones who are paying the price. I think at this point we continue to watch the situation closely, and I would defer other questions to the FDIC.
Fair enough. She's like, stop talking to me me about this. Heather, just to wrap up here, we do have that meeting with congressional leaders and the White House on the debt ceiling. How far apart are the two sides right now?
Well, right now we are in quite a challenging situation. We know, and Secretary Yellen announced earlier that the debt ceiling could be breached as early as June 1st without congressional action. That is a top-line #1 priority. Getting close to that ceiling, let alone crossing over it, could be economically devastating. Our own analysis at the Council of Economic Advisors indicates that getting close to that could lead to the loss of hundreds of thousands of jobs, and going past it for an extended period of time could lead to over 8 million jobs lost. Those estimates are broadly consistent with other analysis that came out from Moody's Analytics that said that actually if we went with the Republican-only plan that the House put forward that has these broad, significant cuts across many federal programs, that doing that would actually also likely lead to recession and the loss of nearly 800,000 jobs next year. So we are in this situation where we need to solve it. It's why the president has been focused on the fact that we need a clean debt ceiling increase, and we should lead these conversations about what future spending is to the conversations around the budget and appropriations process, because the most important thing, we're here this morning to talk about the jobs, the most important thing is that we maintain this economic recovery, and we have a lot of conversations here about how whether or not it can be maintained, and one of the biggest factors is moving forward on a clean debt ceiling increase. That's one of the best things we can do to stabilize the job market.
The sun is certainly shining on Washington, D.C. today. Heather, great stuff. Thank you very much indeed. We always appreciate your time. Thank you so much for sharing some of it with us here at Bloomberg. Heather Boushey joining us from the White House. Coming up, we're going to put our question of the day, the Fed's next move, hike or cuts, to Michael Sonnenfeld, founder and chairman of Tiger 21. That conversation next. This is Bloomberg.
We beat across the board. Job creation, wage growth, labor participation force, and also the unemployment rate. That's the good news. Now, even when you adjust for the revisions as Mike said, 149,000. We still beat across the board on the other three things. So it is good news for an economy that's trying to avoid a recession, but it makes the Fed's trilemma even harder.
That was Bloomberg opinion columnist Mohamed El-Erian on Bloomberg TV earlier, which brings us perfectly to our question of the day. What's the Fed's next move, hike or cut? Michael Sonnenfeld is owner, founder, and chairman of Tiger 21, and he joins us now in studio. Michael, a real pleasure. Thank you for joining.
Thank you for having me.
Okay, next move, hike or cut? What do you think?
I think it's split right down the middle. There have a tug of war between the inflation hawks. Job numbers were really strong. A lot of mixed signals, and then you have all the problems with the regional banks, so it'd be hard to know. Obviously, they were down to 25 points on the last round, so it's even money.
That sounds like a confusing place to be as an investor. Michael, how are you thinking about, therefore, this world as an investor?
You know, our members are former entrepreneurs who are trying to have an all-weather portfolio. So they have a lot of stock, public equity, private equity, and real estate so they can benefit on the upside, and a lot of cash in case the market goes the other way. And by having that all-weather portfolio, on days like today when the numbers are so strong, they're pretty happy. But last week when the regional banks were getting concerned, their cash gave them a lot of comfort.
We've seen a lot of money go into tech based on a Fed pivot, et cetera. Do you see that? Is that what your clients are doing? Like, is that what's happening? Is it a good move, bad move?
So tech has been our number one focus for many years. We live in a tech economy. Tech is changing the world. And our members not only are in tech, a lot of venture capital and climate related to tech, climate tech. So technology is going to keep marching forward no matter what.
Yeah, it is. But the real question, Michael, is how you value it. And a lot of the valuation arguments I'm hearing around tech at the moment are based on the idea that the Fed is going to cut. The market is treating this tech investment story as a rate story. Is that the correct way to approach it? And if that is the correct way to approach it, shouldn't we be slightly worried that the Fed may hike still, may continue to hike? It may not cut. Those cuts may not be coming.
You know, this is Berkshire weekend, and Warren is the best example of a long-term investor. Look at what he did with Apple. Our members are trying to look past the next rate hike or cut and say which are the tech franchises that are going to change the world. And that's been a much better strategy over the long term.
Oh, fair enough. I'm also wondering then how you wind up looking at the bank situation. So it's hard to know how to invest in tech when you don't know what the regional banks are going to do. And I appreciate it's long term, but nonetheless, that could see a lot of volatility. How do you think this plays out?
So the banks are concerning not because of the couple that failed, but because the sea change of policies is going to make lending much more difficult.
Yeah.
Our regional banks support our entrepreneurial environment. A lot of our members are focusing on venture these days, where banking is a little less important. At the very early stage, debt is not as critical as when you grow a company. But it's a real concern because with all the strong jobs and inflation concerns, if we don't have a functioning regional banking system, that'll be a brake on growth.
When are we going to know whether or not we've got a big problem here, Michael? You've been round a number of different crises. How does this one feel? How does this one compare? Does it feel like we're in the early innings of a banking crisis? What is your gut telling you about what is going on?
You know, it's said when a pebble starts to fall, you don't know if you have a landslide. We have a lot of mixed signals now, and our members are really appreciating this all-weather approach of having cash in case the worst occurs, but still being invested in long term. And with a little discipline, if you look over the horizon, that'll serve you well.
I'm wondering where private equity fits into that. Super popular. Everyone's talking about how commercial real estate and private equity is going to be at risk, but no one's going to take that bullet. Everyone's like, not me though. I'm awesome. Everyone else is going to be at risk. How do your members think about it?
So one way to look at it is private equity is 31% of our members' portfolio. That's up from 10% a decade ago. It's a huge amount. But our members are former entrepreneurs. They roll up their shirt sleeves and they get involved with these little companies. They're the first to know when a problem is so they can fix it. And over the long term, that's where the most money has been made.
Michael, you said something really interesting earlier on. You were talking about the technology sector and your members are trying to figure out who are the long-term winners in the tech space. Clearly not everybody's going to win. There has been a huge rock thrown into the technology sector over the last few weeks. It's been a long time coming, but here it is. ChatGPT, AI is here. I still don't know whether the current crop of companies that dominate the tech landscape are going to continue to dominate in a world where AI plays a greater role. What do your members think?
Well, clearly two of the biggest players are Google and Microsoft, and you can have a proxy for AI by investing in Google and Microsoft if that's where you think the market is going. Artificial intelligence is also going to have a huge impact on climate, where we're going to need a lot of new technologies to fight climate. So you can look at some of the climate plays as well. But the largest technology companies are investing heavily in AI, and that's where the opportunity is if you're a believer in it.
So if your members have like 11% in cash, right? If there is a recession and growth really falls out and things get really bad, how quickly do you sense that they're going to be putting that money to work?
So part of the 11% is to have the luxury not to sell in a downturn. That can be more valuable because people get caught in a pinch and they liquidate at the wrong time. So even if they don't use those holdings to buy, it's an ability to not be a forced seller. But 11% gives you enough money either to live for 5 years without having to sell or to pounce on an opportunity. But when they use that 11%, they replenish it pretty quickly by liquidating other things.
Okay, so they're running a pretty big, substantial amount of cash, which you're getting paid for right now. The rates you're getting on cash are pretty good. Not quite compensating in all cases for inflation, but certainly good. Michael, what kind of inflation rate are you basing your thinking on right now? Are we going to get back down to 2%? Are we going to live with 3%? Because that's going to have a meaningful impact on what kind of rate of return, what kind of portfolio you're going to be building.
So when our members meet in meetings all over the globe, we have about 100 groups. This is one of the big discussions. And the consensus is assume inflation will be what it is. Make sure it makes sense in this environment and go from there. Don't assume you can foretell where it's going because it could go either way.
Great stuff, Michael. We appreciate it. An important conversation. Really interesting, too, the idea that maybe we won't see that ton of forced selling. Michael, appreciate it. Michael Sonnenfeld of Tiger 21. All right, it is speaking of tech, 22 past 7 on the West Coast. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, we're looking at Apple here.
Yeah.
Quite surprising, considering that the Qualcomm read-through was pretty grim.
Yeah, it was. And look, the iPhone is center here, right? They beat expectations on the iPhone. Year-on-year growth, 1.5%. Broadly, actually, revenue declined year-on-year for the second consecutive quarter. And if you listen to the guide that the CFO, Luca Maestri, gave, they're on track in the current period for a third consecutive year-on-year quarterly sales growth decline. Emerging markets are just at the heart of this story. India, they face real FX headwinds at the top line and at the bottom line in the quarter gone, which they expect to dissipate on the bottom line going forward. But India, and iPhone relevance at a time where smartphone demand just isn't there.
Why is Apple so difficult to call at the moment, Ed? Is it because of that increasing dominance of the emerging markets within their numbers? Everybody was expecting this to be a difficult quarter. It didn't turn out to be. Apple in so many ways shouldn't be volatile, but it is.
Yeah. Yeah, remember in the December quarter how impactful supply chain snags were? You know, a number that caught my eye was the inventory days being more than 12 days of inventory, highest level going back to Q1 2019. So that was an interesting stat. It looks like they've got the ability to supply those products that are in demand. So that was one factor. The demand does seem robust. Services was another bright spot, right? It missed expectations. However, it's still a unit that grew year on year around 5.5%, particular strength in China on services. So it's just a much broader offering now. The kind of key stat is that globally the installed base of devices hit a new record. So if the iPhone's strong, great, but they're seeing pockets of demand for other products in other places. You know, a key stat is that in the Asia market, for example, 2/3 of watch buyers, 1/3 of MacBook buyers, they were coming to that product for the first time. They've not owned an equivalent product from Apple before. So they're clearly finding resonance in those markets.
Can I just be a little skeptical for a second? Is this like the classic Apple under promises and over delivers? Because this was like the Apple Jam for quite a long time.
Look, Tim Cook was pretty muted. I wrote on the Top Live blog there were no fireworks in this earnings, right? And that, you know, they did carefully guide into the current period. Where they were most muted, I'm just going to go for it, artificial intelligence. Let's just listen to what Tim Cook had to say about AI as an example.
I do think it's very important to be deliberate and thoughtful in how you approach these things. And there's a number of issues that need to be sorted.
Thoughtful, deliberate, competent in AI machine learning, but how different was that to what we heard from Zuckerberg, Nadella, Pichai?
Yeah. Is that a good thing or a bad thing? That's what I can't figure out yet.
Yeah.
Maybe they're cautious. Maybe they're just hiding what they're doing, being a bit more cautious in terms of what they're revealing. It would be surprising if Apple wasn't spending a great deal of time and effort and money thinking about what is happening here. It's also, I just find it fascinating what's happening with the consumer versus the enterprise story as well. Ed, great stuff.
Yeah.
Fantastic coverage. I really enjoyed what you did last night and into this morning. You could, of course, catch Ed coming up on Bloomberg Technology. It's around 90 minutes time with Caroline Hyde. Looking forward to that. We're going to carry on our conversation here. The Fed's next move. Is it a hike or is it a cut? Julia Coronado is going to join us next. This is Bloomberg.
We're about an hour into U.S. trading session. Stocks really flying here. Abigail Doolittle is tracking the moves. Abby?
Yeah, big gains, Alex, here. We have lots of green on the screen with the S&P 500 up 1.4%. It's best day in, funny enough, it feels like it's been a long time since we've had an up day, but it's since April 27th. You can see the NASDAQ 100 higher, the Russell 2000 outperforming a little bit, and then take a look at the KBW Bank Index really having a very solid day. We'll be taking a look at some of those movers in a moment, but up 3.8%. On the week, though, all of these indexes lower. Let's take a look at a big contributor to both the S&P 500 and the NASDAQ 100. That is Apple, a better than feared quarter. They did see revenues and sales and earnings decline on a year-over-year basis, but they beat estimates right across the board, except for services, but nonetheless much better than feared. So here is the reaction, up 4.5% on the day. This is the one-day change, saving a down week, but the rest of the indexes, having been weighted on not having this big burst higher, are lower on the week. So it's an interesting bifurcation that we're seeing today between the day and the week. As for the year, let's bring it all together because we are having some big outperformance for the mega cap tech stocks. Now this is a bit of a busy chart, but what we're looking at here up top is Meta, many of the mega cap tech stocks, including Apple in pink here, and then in purple we have the equal weighted S&P 500, barely positive on the year. The S&P 500 up about, I think it's 5 or 6% on the year, but you can see that mega cap tech this year really doing really quite well, outperforming this year's safety trade. As for some of the big movers on the day, let's take a look at these big banks, and this is just incredible. We had declines of this size yesterday for these two stocks. PacWest and Western Alliance both sharply higher. Again, this seems to be a bit of a crisis in confidence. So today there's a little bit more confidence that PacWest may in fact find a potential suitor to take it over. Western Alliance saying that that is absolutely not happening, but we see these shares rebounding. Lyft, on the other hand, down 19%. The second quarter outlook for sales not great. The per rider economics diminishing, even though demand for overall ride hailing is pretty strong there. Apparently they are sacrificing the near term for the long term, at least one analyst suggesting that. And then Carvana is talking about a profit guy in this current quarter, up 34%. And this stock is just simply wild. This used car stock, lots of volatility in that market. But at one point 2 years ago, it had been a $372 stock. At one point not so long ago, it had been a $3.72 stock, a 50% short interest. Big squeeze, guy.
Absolutely. Talking of squeeze, you look at what's happening in the banks. You've got to figure that a lot of people probably have short positions on. Do you want to carry that kind of risk over a weekend with some of these bank stocks? Repositioning, it feels like. I wonder what's going to happen Monday. I think Monday could be an interesting day. Are we back to the previous narrative? Certainly very whippy. Abigail, thank you very much indeed. Abigail Doolittle, and what's happening with the markets. Let's get back to the data. Let's get back to that incredibly hot jobs number that we got earlier on this morning. Certainly maybe increasing the odds that the Fed will hold rates at current levels for a little bit longer. We pushed out some of the cuts that we were earlier pricing. A few minutes ago, we had the opportunity to catch up with Heather Boushey, member of the White House Council of Economic Advisors, about these numbers.
The proof is in the pudding. Under the president's watch, we've added 12.7 million jobs now. We're seeing that pull people back into the labor force, and this is all good news for the strength of this recovery and for working families all across the country.
So that's the White House's view of these numbers. Let's talk about the Fed's view of these numbers, which takes us to our question of the day. The Fed's next move. Is it a hike or is it a cut? Joining us now, Julia Coronado, Macro Policy Perspectives founder and president. Julia, nice to see you. What do you think?
Good to see you. So on the question of is the next move a hike or cut, I do think the next move is probably a cut, but I don't think it's going to come as quickly as the market expects. I think the resilience of the labor market is another reason, an illustration of why the Fed thinks it's going to have to hold rates higher for longer, and that right now is the way that they're balancing the risks, the strains on the banking sector versus inflation that's still running too high and not showing enough convincing signs of moderation. Just keep rates in restrictive territory, keep that QT ongoing and watch the data. the data are not turning on a dime. The data do not suggest we are teetering on the brink of a recession.
Well, Julia, though, to that point, maybe we're not teetering, but if you take a look at, say, the JOLTS data, that shows a little bit of a different story, right? Revisions for the labor market data. We also have the regional bank problem. Like, can we really believe this data that we got?
So, I agree, there are under the hood of this headline number, there is definitely a moderation, a cooling in the labor market. So the main margin of cooling this year has been in hours worked. So the work week went from, excessive overtime to a pre-pandemic norm for the work week. Hours worked, total hours worked, actually fell over the last 3 months. And that is where take-home pay comes from. So yes, nominal income growth, the breadth of sectors hiring, all of these things are pointing to a cooling in labor demand. So it's not like that just one headline payrolls number is the full story.
Absolutely. We're trying to pull all the numbers together, trying to get a better understanding of what is happening here. Alex, I do wonder, I won't be here, but you will be, Monday, with that senior loan officers survey, whether or not ultimately we are going to be seeing a change in the narrative again, because that could point to quite a significant tightening of policy.
I love the guy love the slews now. I totally dig this. So Julia, to that point, what kind of feed through do you think we're going to get from the slews to that regional banking / credit crunch right now?
Yeah, no, exactly. And that is a leading indicator, right? I mean, the labor market is probably concurrent indicator of conditions. What's coming next probably is going to be signaled by the senior loan officer survey. My read of Powell's comments was that he confirmed we should see an additional tightening. Let's keep in mind that already showed pretty substantial tightening in Q4 and Q1. You put that through a macro model, and it will predict a pretty big drag on GDP growth from tighter credit. Now, this is something that shows up with a lag. It takes a couple of quarters for this really to hit us. So we're probably looking at a more material headwind on the economy in Q4, turn of the year. That's kind of the timing that I would think we're really going to see the bite from the credit crunch, which is real.
Julia,
we know it's real.
We're going to see that certainly showing up, as you say, but maybe not now. Maybe it's further down the road. Let's talk about the inflation data that we're going to see next week as well. Like the labor market, and I'm sure the two are related, we are seeing inflation coming down relatively slowly. Where do you think ultimately, given the current policy setting that we have from the Fed, that inflation is going to bottom out?
Yeah, it's a great question. Inflation has been persistent. It's been sticky. It has moderated and definitely stabilized, but it isn't cooling in a particularly decisive fashion. In the near term, next week, we're going to have upward pressure from a rebound in used car prices that happened during the tax season. So that's normal, that people are less price sensitive when they get their tax refunds, but already wholesale prices are showing that that's going to reverse over the next few months. So I think it's going to take really, again, towards later in the year that we're seeing core inflation moderate more decisively. We've started to see rents cool, and a lot of it's got to come through cars and goods prices still. Services prices are probably going to be the lagging indicator, but we should be seeing a combination of consumer price sensitivity pressuring goods prices and that moderation in rents coming through, again, more decisively later in the year. The Fed has to tell that narrative and let us know that that's coming, and they're pretty nervous after a lot of false starts in that inflation cooling. Powell pointed to that in the press conference. One reason they hang on to that tightening bias is not because they don't think policy is restrictive. They just haven't seen enough evidence that inflation's coming down decisively enough.
Which, Guy, brings me back to the point that we were talking about at the top of the hour. Does that bring back a hike conversation for June? Do we have to really consider that?
Well, as Julia was saying, maybe they just leave it on the table. Maybe that risk just remains, which then pushes out the possibility of a cut. The market has gone all in on this idea that we're going to see cuts, that we're going to see significant cuts. There's a lot of them priced, and maybe the longer the Fed leaves that possibility of a hike on the table, the more distant those cuts become. Julia, what do you think of Fed communication? Do you think the market is getting the message right now?
Well, so I think one, the point you just made is excellent. I think that is one of the reasons they hold on to the tightening bias is not because they actually think they have a lot more to do, but because they don't want the market to run even further ahead of them. And so I think the bar is pretty high for a hike in June. If data continue to run hot and banking turbulence settles down, maybe we're talking about one later down the road. I think, right now, there is really just a different view of the world. I think that market pricing reflects a mixed possibility. The median outcome, the weighted average outcome is a mix between a catastrophic turn in the economy where we dive into a recession pretty quickly and one where we actually prove resilient and muddle through this banking turbulence. So, the Fed's baseline outlook is that we will err more on the side of resiliency, and that will require tighter policy for longer. The data so far are voting in their favor, but again, we've got a whole new element from the credit squeeze on regional banks and super regional banks. These are not small institutions. They do a lot of lending into the economy. So if they're tightening standards, that will be felt. It's just not in the data we're seeing right now.
Julia, great stuff. We appreciate it. Thank you so much, Julia Coronado of Macro Policy Perspectives. We appreciate you. All right, coming up, we're going to talk more about regional banks. Rebounding after yesterday's rout. That sell-off, though, increasing scrutiny on short sellers, the fundamental versus the sentiment. We're going to talk about potential regulations with Paul Atkins, Potomac Global Partners CEO and former SEC Commissioner. This is Bloomberg.
up to date with news from around the world. Here's the first word. I'm Simone Foxman. The World Health Organization says COVID-19 no longer qualifies as a global emergency. But although this marks a symbolic end to the pandemic, the WHO points out the virus is still around, noting recent spikes in cases in Southeast Asia and the Middle East. The agency says thousands are still dying from the virus every week. The coronavirus has killed at least 7 million people worldwide. President Biden reportedly will name the Air Force's top general to become the chairman of the Joint Chiefs of Staff. That's according to the New York Times. General Charles Brown, the Air Force Chief of Staff, would become only the second black man to serve as chairman. Colin Powell was chairman under Presidents Clinton and George H.W. Bush. And the UK is preparing for its first coronation in 70 years. King Charles III will formally accept the St. Edward's crown during a service Saturday at Westminster Abbey. The coronation is expected to be a gift for the country's pubs and restaurants. But because it also includes a national holiday on Monday, there's speculation that the whole thing could lead to a slight drag on GDP in May. Global news, 24 hours a day, on air and on Bloomberg Originals, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Simone Foxman, and this is Bloomberg. Alex.
All right, thanks so much, Simone. So regional banks getting a break today. However, the last couple days have been truly terrible for some of these regional banks. It's increased the conversation around short selling. Are short sellers pushing around these stocks, and we need to fix that on a regulatory level? Well, Rebecca Patterson, Bridgewater Associates' former chief investment strategist, talked to us about the possibility of a ban on short selling yesterday.
The SEC certainly has the ability to take steps like that. I have no idea if they would. And the Federal Reserve has additional steps it can take with emergency lending facilities. Most of the small and medium-sized businesses in the country get their money from the small and medium-sized banks. So it's just a bad time to be small, whether you're a bank or a company in America right now.
I mean, those are some thoughts there. Paul Atkins joins us now. He's Potomac Global Partners CEO and former SEC Commissioner. Paul, it's really hard to ignore that the shorts may be pushing around these stocks. Do you think that's true, and should there be a short selling ban?
Well, I've never been a fan of short selling ban, and as you just heard, the SEC does have the authority to do that, but I think that would be a big mistake for them to do that. It showed in 2008, it was shown to be ineffective, and because there are many other ways to short a security, not just by shorting it, but through the derivatives markets and otherwise. So it's really sort of just a bad policy. Yeah. And it distorts markets, and it creates more panic, I think, than otherwise.
Paul, nevertheless, we do seem to have moved from a situation where we're trading on the fundamentals for the banks to where we're not trading on the fundamentals on the banks. We don't know what's going on within many of these institutions, in the market, judging by the moves we've seen over the last few days, is in certain cases ignoring some of the news that it's getting. Have we moved to a point where we need to do something? Do we need some sort of a circuit breaker? How do we control this market and the way it's treating these institutions?
Well, you know, this is a big issue, the whole issue of what we call confidential supervisory information, the whole thing of bank secrecy and the way the regulators try to control information from the market. So really, every day when you think about it, there, especially for large banks who depend on commercial paper, which is essentially an IOU and a very short-term debt instrument where they borrow money to finance their operations, they depend on, there are people out there, flogging those securities, but they don't really know what the regulators think and see behind the scenes. They're just looking at the static financial statements. And so that is one thing where the market then, especially with banks, where their assets are not marked to market every day, then, that creates issues.
But Paul, that also implies that facts would help stop this. And I say that because the banks have said that their deposits have actually increased, and that hasn't really done anything. So it doesn't necessarily feel like more information would be better.
No, but it kind of sets an underlying tone, because in times of volatility, it's hard to say that more information would stop a run or whatever, but it sets an underlying tone for the total way that people look at financial stocks, and especially if they're not sure what the true mark to market is, because the unrealized losses, anytime that you start having a volatile interest rate environment like we saw at Silicon Valley Bank and others, you look at the Fed, they're sitting on huge unrealized losses. But the argument is we're holding this to maturity, so it doesn't really matter. For banks that have to finance operations with short-term loans, it could and perhaps does make a difference.
If the hold to maturity book was mark to market, if we had better visibility on what is happening with deposits, do you think that the market would calm the situation down?
Well, you never know. I mean, you look back at 2008, so even though, Bear Stearns and other securities firms, of course, have to have their, their assets marked to market, it really, didn't really stop things, because there was the leverage issue and everything else back then. So now, when you look at, especially as regulators, and I think that's the real failing with the way the Fed and the FDIC were dealing with the failures of Signature and Silicon Valley Bank. They didn't really take, it's like at the beginning of the bank examiner's manual, to look at interest rate mismatch and to examine for that. They failed in that aspect here. And so the report that came out that Michael Barr issued, kind of touches on it, but I think it really disingenuously tries to, point the finger at his predecessor, which I think is completely, a crazy type of thing to say.
Well, Guy, it also raises the question, do we need to see universal deposit insurance at the end of the day? Like, is that, it has to go through Congress, sure, but is that the only thing that's actually going to provide true immediate confidence?
We can't afford it.
Maybe certainly one of them. Yeah, well, maybe in the short term we could afford it, Paul, and I think that may be one of the questions I think the White House is grappling with right now. But Paul, Alex raises an interesting point about whether or not we need this now. Has the world changed? We may not be able to afford it, but in a digital world where money can come out of banks in a heartbeat, how do we manage the speed at which things can change? Is the only way to basically say your money's good, don't worry about it, because otherwise you have a kind of tragedy of the commons kind of environment where the market, where depositors are looking around them and going, should I take my money out now? Things could get out of control really fast. Do I want to be placing myself in that kind of situation? The world has changed. The digitalization of banking has changed the situation.
No, that's true. That's absolutely true. But can the government, and will the market believe that the government will backstop every single penny of every single deposit? Does that invite everyone from around the world to come to the United States, and the United States government, the taxpayer really ultimately, because a bank insurance fund, you could never have enough money raised from private banks to possibly, guarantee all of that. And maybe, maybe there's some calibration that needs to be done for corporate deposits and whatnot, but you have a huge issue, and the increase from $100,000 to $250,000 back, whenever it was 14 years ago or so, has had to be dealt with a bank insurance